Joining us now is Bob Shea, CEO and Chief Investment Officer at TrimTabs Asset Management. And we know the numbers are probably going to be pretty good. The stocks have performed well already. Do they need to beat by a certain amount, or is maybe the outlook what traders will key off of, Bob?
Good morning, Joe, and thank you for having me on. At TrimTabs, we are a boutique investment manager that has a suite of free cash flow ETFs, our flagship being the U.S. free cash flow ETF, quality ETF, which would have these exposures. But actually, what we focus on in our process and how we're different than most other managers, we're focused on quality, and in particular, free cash flow quality. We look at these earnings through the lens of a TrimTabs quality model, and the most important factor for us is the free cash flow profitability factor, which is our proprietary look at versus what most people look at, which is GAAP earnings, which can be more easily manipulated and distorted. And what we're seeing, and what we saw in Q1 with a lot of these mega cap tech names, is they beat their net income dramatically, up some 198% versus 19% for the rest of the S&P 500. Free cash flow or operating cash flow grew nicely, but not really keeping up with that net income, thus creating some spike in accruals. And we actually have a pretty significant underweight in the what we would call the FANG, including Tesla space, by some 1,500 basis points. Not bearish; they're just not making the cut. We are obviously are focused on free cash flow. Tesla reported last night. They increased net income tenfold. Operating free cash flow grew 1.5 times. From a free cash flow profitability standpoint, they did quite well. However, quality of earnings, operating cash flow not keeping up with net income. I would contend, and again, we do, interestingly enough, have an overweight in the information technology space, where names like Accenture, Palo Alto, old tech names like Cisco, IBM, really score much better from our vantage point. We really do go where the free cash flow is, and so we are underweight this group, which has been rallying nicely, Joe, as you know, but I would contend is more a function of what's happened in interest rates, risk parity flows, and performance chasing into these earnings.
Squawk and TrimTabs goes way back to the Chuck Biederman days, obviously the founder, who always he looked at liquidity as well, but also how much stock was being bought back and how much was still available. That was so important at this point. So if you had to look at free cash flow for the most, the key players this week, which ones would be most important for you to decide whether tech continues to lead or whether we get a shift to value at some point? Who should we be watching with who's coming out this week?
Look, I think the setup going into earnings is these names have been bought in anticipation. There's been quite a rotation. You've talked about, unfortunately, some of these mega cap tech rallies really come at the expense of the broader market. There's just, as we can see, breadth has been bad and a terrible divergence.
Shepard Smith here. Thanks for watching CNBC on YouTube.